Starting a business with limited financial resources is a common challenge for many aspiring entrepreneurs. However, with the right strategies and mindset, even a cash-strapped startup can navigate its way towards becoming an investor. In this video, we will explore practical tips, including mathematical examples, to help you transform your startup into an investor, even without significant funds. Tip 1. Develop a clear investment strategy. Building a successful investment portfolio begins with a clear investment strategy. For example, let's say your startup is in the technology sector and your goal is to invest in early-stage tech companies. You analyze historical data and identify that the average annual return for tech startup in their first 5 years is 20%. With this information, you can set a target return rate for your investment, such as 25%, to account for the higher risk associated with the early-stage companies. This calculation helps you define your investment goals and evaluate potential opportunities based on their expected return. Additionally, you can use financial models such as discounted cash flow analysis to assess the present value of future cash flows and determine the attractiveness of an investment. By discounting the projected cash flows of a startup at an appropriate rate, you can calculate the present value and make informed investment decisions. Tip 2. Cultivate a strong network. A strong network is invaluable for a cash-strapped startup looking to become an investor. Let's say you attend an industry event and meet an experienced investor who has a network of successful entrepreneurs. Through this connection, you gain access to a promising startup seeking funding. By analyzing their financial projections and growth potential, you estimate that their valuation could increase by 300% within 3 years. With this information, you can evaluate the investment opportunity and consider the potential return on investment, taking into account factors such as your investment amount, equity stake, and expected exit strategy. Networking can also help you identify co-investment opportunities where multiple investors pool their resources to invest in a startup. For example, you connect with 2 other investors who are interested in the same startup. Each investor contributes $50,000, resulting in a total investment of $150,000. By collaborating with other investors, you can spread the risk and enhance the potential returns of your investments. Tip 3. Collaborate and partner with others. Collaboration and partnership can be a powerful tool for startups without financial resources. For instance, let's say you collaborate with an established company that operates in a complementary sector. By pooling your resources, you can invest in a joint venture to develop a new product or entire new market. For example, your startup specializes in software development, while the partner company has expertise in hardware manufacturing. Together, you analyze market demand and estimate that by combining your strengths, you can capture 10% of the market share within 2 years. Based on the projected revenue and investment requirements, you can determine the potential return on investment for this collaborative venture. Another collaboration option is participating in syndicate investments, where a group of investors collectively invest in a startup. Let's say you join a syndicate of 5 investors, each contributing $20,000, with a total investment of $100,000. You can negotiate favorable terms and potentially secure a higher equity stake in the startup. By leveraging the collective resources and expertise of the syndicate, you can enhance the chance of success and increase the potential returns on your investment. Tip 4. Focus on value creation. In the absence of substantial funds, focusing on value creation becomes crucial. For instance, let's say your startup provides strategic guidance and operational expertise to early-stage companies. In exchange for equity, you identify a promising startup with a pre-investment valuation of $1 million. By providing your expertise and support your estimate that can help the startup achieve a post-investment valuation of $5 million within 3 years. Based on this valuation increase, you can determine the potential return on investment and assess the value you bring to the investment opportunity. Furthermore, you can use financial metrics like return on investment and internal rate of return to measure the performance and the profitability of your investment. For example, if you invest $100,000 in a startup and after 5 years, your investment is worth $300,000, the return of investment would be calculated as $300,000 minus $100,000 divided by $100,000 equal 200%. Similarly, internal rate return helps you determine annualized rate of return that investment generates over its lifespan. Tip 5. Embrace alternative funding source. When traditional funding is scarce, exploring alternative funding source can be a game changer. For example, let's say you're leveraging crowdfunding platform to raise capital for investing in startups. You set a crowdfunding campaign with a target investment amount of $100,000, offering equity to investors. By analyzing the campaign performance and investor response, you estimate that you can attract average investment of $500 per investor. With this information, you can calculate the number of investors needed to reach your target investment amount and evaluate the potential return on investment based on the project success of the startup in your portfolio. Additionally, you can explore government grants and funding programs especially designed to support startups and innovation. For instance, let's say you apply for a government grant that provides $50,000 in funding for an early stage startup. By receiving this grant, you can reduce your financial constraints and allocate the funds towards investment that align with your investment strategy. Assessing the potential return on investment and comparing it to the grant amount can help you determine feasibility and attractiveness of such opportunities. Becoming an investor as a cash-strapped startup is undoubtedly a challenging endeavor. However, by following these tips and leveraging mathematical analysis, you can increase your chance of success. Remember, it's not just about the money, but also the value you can bring to potential investment. Cultivate your network, collaborate with others, and embrace alternative funding sources. With perseverance and a strategic mindset, your startup can make its mark in the investment world regardless of financial limitations.